Hello, Craig from Wealth Minus Wall Street. Today, we're going to talk about how to create a stress-free retirement. And one of the things that we see when we talk to folks for the first time is that the retirement plans and the retirement strategy rarely come with guarantees, and that creates stress and uncertainty. And today, we're going to talk about a few ways to remove that stress and live comfortably in retirement. So before we jump in, let me just really quick introduce myself in Wealth Minus Wall Street. So I spent over 20 years as a financial advisor. So I know firsthand how the Wall Street business model is rigged and, in my opinion, broken, clearly putting the best interest of Wall Street and financial professionals ahead of you and your money. And my goal was to create a platform for people to get insight and information that Wall Street has vested interest not to provide. And the reason they don't want to provide this is because it opens up a can of worms where you're more educated about fees and what you get with fees, and that'll create a problem for Wall Street. And really, the result of this is our role is more as an advocate and not an advisor. So we're not trying to manage your money. We're taking our experience from managing people's money and we're evening the playing field, if you would. So we're putting your best interests first instead of, whether you realize it or not, your best interest is not first right now, and we'll make sure that it is moving forward. So Wall Street's dirty little secret is that financial advisors make more money from growing your assets and not your income, okay? So when you think about retirement, if you're already there, if you're getting close, you need income, right? Assets are just where you get the income from, right? Income is really the key to happiness in retirement. And financial advisors make more money by managing and growing assets than growing your income. This is a huge reason how we say your best interest isn't always being served. The good news is, watching this presentation, we're going to explain to you how that can change and put an equal focus on income as opposed to just assets. So here's what we would call the current retirement crisis. Seeing this right now just because of the environment that we're living in. It's really an hourglass. Your assets are at the top and the income is at the bottom. And what too many people do is they just stress and worry about those assets getting smaller and smaller and concerned about that hourglass running out. And that's the business model of Wall Street. We want you to pay closer attention to income generation to help protect you from worrying. And worrying usually means making irrational investment decisions that can negatively impact the retirement plan. This is from Robert Merton. He's an economist, the Nobel Prize winner. And he essentially is echoing what we're talking about. Successful retirement is defined as stream of income sufficient to sustain your chosen standard of living. That standard of living is measured by income, not the value of a pile of money. Here are the risks that can derail a retirement plan. You have the risk of rising taxes, because remember, most people that we work with, a majority of their assets is in tax deferred vehicles, which means when that money comes out, it's fully taxable to you. So there's risk at that. Obviously, as taxes rise, your income could go down. There's inflation risk, which we're all experiencing right now. Inflation is at 40-year highs. There's interest rate risk. What if interest rates go up? Withdrawal rate risk. What if you're taking too much money out and you increase the potential of depleting your retirement assets? There's regulatory risk. You know, what if things change? What if IRAs change in terms of how the regulators view them? There's market loss risk. And this is one of the big problems with focusing strictly on assets, is you really never remove market loss risk. So you're always kind of at the mercy of the market, and that can create a lot of worry and stress. There's healthcare risk. One of the things that we see a hole in a lot of retirement plans is not having an adequate solution. God forbid you or a spouse has to spend an extended period of time in an assisted living situation that can significantly deplete retirement assets. And then longevity risk, right? We never want to think about, oh man, if I live too long, that's going to impact the amount of money that I have, right? We want you living as long as possible. So we don't want you worrying about how living too long can actually cause you to run out of money. And as I mentioned quickly with that market risk, these risks that we just talked about, they're always there if you follow the Wall Street status quo, the Wall Street business model. If you're just focusing on assets from what Wall Street sells, you're always at the mercy of these risks. So here's Michael Fick, an economist from Ohio State. He mentioned certainty provides confidence. This is one of the reasons that retirees who've incorporated guaranteed income into the retirement planning report higher levels of satisfaction. And we see the same thing just in my experience as an advisor. The folks that have guaranteed income coming in, they're less stressed about what goes on in the market. And there was a study, University of Michigan did this study, and they found what we just talked about, is more income coming in, the satisfaction rates went up, people were happier, and it equated to a more successful retirement. So where can you get guaranteed income? There's not many places you can get it. Social Security is one. So most of you are collecting or will collect Social Security. Pensions. Some of you might be fortunate enough to have pensions. As we all know, corporations have pivoted away from giving pensions, so they're not as likely as they used to be. And then annuities, right? So annuities you can purchase on your own that act like Social Security, act like pension, meaning as long as you live, there's an income stream coming in, protecting you from outliving your money. So let's take a quick assessment of where we are today. The stock and bond markets are down significantly, double digits. So this is and the potential is there that this might only be the start of this downturn. Nobody has a crystal ball, but things are still not looking great from an economic perspective and a market perspective. We have surging inflation, 40-year highs that we're all experiencing at the grocery store, the gas pumps, unprecedented global debt. The Fed is in a hiking cycle, so they're raising interest rates pretty aggressively. Depending on who you talk to, maybe we're in a recession. If not, there's probably a looming recession. Most folks agree that the economy is weak and it doesn't look like it's improving anytime soon. So the Buffett indicator, for those of you who don't know Warren Buffett, one of the most successful investors of our time, he came up with what's called his Buffett indicator, and it takes the value of the US stock market to the GDP, which is basically a measurement of the health of the economy. And what he found is when that ratio gets too high, that's a pretty good indicator that the markets are going to experience a downturn. So what you've seen, really the 2000 peak, we were significantly higher than what they call trend line. And once it kind of hit that 2% standard deviation, we saw that big correction from 2000 to 2002. Then in 2008, we got a little bit extended, and then we sold off very aggressively, and that was a great time to buy. And then what we saw this year in 2022, we peaked earlier in the year, and we've come down significantly. But here's the thing, we're still about 30% higher than trend line, right? So that would mean that there's a good probability that the market still has further to decline. So we still think we really want to be cautious at this point. Here's just some Wall Street track records. I know this might be tough to read, but it just goes back at different market cycles and what the thought process were. There's a famous quote from an economist in 29, right before the crash, that says stocks prices have reached what looks like a permanently high plateau. I do not feel there will soon be, if ever, a 50 or 60 point break from present levels. I expect to see a good market and a good deal higher within a few months. That was right as the market was about to crash. Ben Bernanke famously stated right in the housing market peak that we believe that the troubles in the subprime sector and the broader housing market will be limited, and we don't expect significant spillovers from the subprime market. Wow, was he wrong? That was the cause of almost bringing the whole financial system to collapse. AIG made a comment in 07. They just talked about, we don't think credit default swaps are really going to be a problem. Again, credit default swaps are one of the reasons the financial market almost collapsed. Couldn't be more wrong. And then this was a study done after the fact, but in late 1999, just a few months before the bubble burst, 1% of analysts, Wall Street analysts, were recommending sells on stocks versus 70% buy. So 70% were recommending a buy at one of the biggest bull markets ever when stocks were at no-please levels. So the point being is Wall Street is wrong just as much as they're right. So if you're hearing, oh, the market's going to come back and we're going to do great, they have no clue. We think it makes much more sense, again, to take a portion of your money at these levels and create guarantees with them rather than playing in the Wall Street casino. So here's some advice from Warren Buffett. Number one, never lose money. Number two, don't forget rule number one, right? Very important to not lose amount of money. And the reason for that is it takes longer to make up for the losses. So this is graphically what I mean by that. So if you lose 10%, you need just over 11 to recover. Go all the way down to the bottom. Of 50% loss, you need 100% return to break even, right? So if you have 100,000, you lose half, it's 50,000. You need to make 50,000 to get back to the 100. Well, that's 100% return. So if we're talking about 8% returns, this is the hole that you dig yourself, right? That you might need a year, 2 years, 6 years, 9 years to get to break even. If you're nearing retirement, you cannot do that, right? You cannot wait that long. It's going to significantly impair your retirement and put more stress on running out of money. And here's an example. Right. So again, as you're getting close to retirement, you have to understand that returns aren't equal, as we just said. So these are two different scenarios. One person retired beginning of 2000, one retired in 2010. The returns are just S&P 500 returns. We started with $500,000 and we withdrew $30,000 a year. And because the 2000 was such a bad decade for stocks, at the end of that 10 years, the person retired only has $138,000. The next decade in 2010, the person has 1.1 million. That's a difference of nearly $1 million. It was all luck, right? You had no idea what the market was going to do there. And we don't think luck is a strategy. This just talks about an indexed annuity, right? So some things that can kind of create guarantees. So we'll talk about this. An indexed annuity essentially guarantees you don't lose money, but your upside's capped, right? If we just take the same scenario in 2000, if you were in an indexed annuity and your downside was 0 and your upside was capped, you almost had 3 times the money, right? So you had $392,000 at the end of the decade versus 138 in the S&P. So Warren Buffett's point of don't lose money, right? Even if your upside's capped, that's okay, because not losing money, you have a higher probability that your money's going to be there for you in the long term. And we mentioned luck, right? We mentioned the Wall Street casino. I mean, that's what we're talking about. Are you feeling lucky, right? Will that next market downturn happen right around when you retire or early in your retirement? We don't want you to have to worry about luck. We want you to plan properly and make sure you're not completely sensitive to major stock market losses. So now let's get in with, right, we talked about the whole, you got to convert assets to income. Here's the problem that financial advisors don't want you to understand. There used to be what's called the 4% rule. And that said, if you take out 4% of your money based on various simulations of risk return of markets, your money will last. Well, because interest rates have been artificially manipulated for pretty much 20 years, that number now from Wade Fowle, who's a retirement income specialist at the American College of Financial Services, he's saying he's finding it's really about 2.4. I know Morningstar has said 2.8. The point being is that number is very small. So if you have $1 million, that means you can take out $24,000 to $28,000 comfortably. By the way, if it's coming out of an IRA, 401k, tax deferred, that's fully taxable. That doesn't seem like a real good deal in our opinion. Let's talk for a second about bonds, right? Because one of the things that you've been told is diversification and asset allocation, and bonds will protect you. Well, look at this year. This is the LQD, which is basically just the corporate bond market. And this is year to date through mid-November. And it lost over 19%. And here's the problem. The environment for bonds doesn't look like it's getting much better, right? You're suffering significant losses in bonds this year. And that's supposed to be your risk protector, risk management feature in your asset allocation funds and strategy. It's not the case. And as I just mentioned, we're not sure that the bond markets recover based on what we're seeing in the financial markets right now. So Wayfell, again, he came out and said annuities are better than bonds for guaranteed income. Once you have your living costs covered with guaranteed income, right, here's the key. You can afford to be more aggressive with your other investments to get better gains. If we draw from our bond holdings to buy an immediate annuity, it can generally better support retirement spending, okay? So this is really, really pivotal. The advantage of creating guaranteed income means that those other assets that are earmarked maybe more for, let's say, growth, okay, you don't have to worry as much about the up and down volatility, because remember the hourglass. We don't have to have that money sink down from assets to income because we already have the income covered, right? So that really helps with returns because, again, when people get stressed and when they're nervous and they're worried, they make bad decisions, typically emotional decisions when it comes to investing that can really put a dent into the success of your retirement plan. So you really have two options here, right? Following the Wall Street status quo or looking at scientifically optimized retirement income planning strategies that create guarantees and remove stress. So here's what the result looks like by following some of these solutions. Produce up to 250% more income than Wall Street guidelines, right? So we talked about that 2.4 to 2.8, right? Significantly improve that, in that 6 to 7% range. Depending on the type of annuity, we'll get into this whole notion about fees, but it actually could have zero fees, so it doesn't cost you anything depending on the type of solution that you think makes sense for you. It gives you similar income with 40% less money saved. So for some of you who are concerned that maybe you haven't saved enough money for retirement or your investments haven't performed like you thought, and you're concerned that you're not going to meet your asset goal, this is a great way to do more with less by creating income instead of focusing on asset growth. This is key right now. You never lose money in market downturns. It's so important, as we just said a couple slides with that sequencing of return and Warren Buffett, you can't lose money, right? So important right here when the market looks like the volatility will continue. Guarantees passive income every month. So again, it creates that Social Security pension, right? I know everything's digital now, but it's like that mailbox money. Every month that check's sitting there for you. Guarantees you never run out of money as long as you live. Gives you a raise when the market goes up, right? Really important for inflation. So your money is kind of locked in and then it compounds off of that higher mark. Very important when it comes to keeping that nest egg where you need it and generating income. And then gives you access to your money if you need it for the long-term care or other emergencies, right? So we talked about it. A lot of the people that we talk to really don't have a plan for long-term care. This is a great way that if you want, you're able to wrap in a long-term care solution and protection into a guaranteed income solution. This is pretty interesting, right? This is observation is why do people hate the word annuity? So workers show strong interest in guaranteed income, but 1/3 of individuals report lower interest in the same guaranteed lifetime income product when it's labeled as annuity. Well, why is that, right? So if you don't use that term, people want to sign up all day long for guaranteed income, right? It's a great thing, but that term annuity has a negative connotation. Well, here's why. We've been told it has high fees. We've been told brokers make big commissions. We've been told that your money's locked away. We've been told it has low returns, and we've been told it's a bad investment. And I will tell you, this is another one of Wall Street's dirty little secrets. The fees that you pay to your financial advisor will make your jaw drop. Okay, when we run these plans, and we call it a retirement audit, we show you that the fees that you're paying to your advisor over your lifetime easily are 6 figures. And that can have an impact of over $1 million of net worth. We have one example where we show a person having $1.8 million worth of money versus running out of money based on whether or not they worked with an advisor. So the fee conversation is kind of silly. There's fees with everything, depending on what solution you want. Our job is to make sure you know the pros and cons in each. And I will tell you that Any fees with annuities or insurance products, here's the difference. You actually get a guarantee. You get something for it. You're already paying high fees especially if you're working with an advisor. And guess what? There's no guarantees associated with it. The brokers make big commissions. Again, I chuckle about that because most people, this is Wall Street saying this narrative, because remember, they don't really want you in annuities because they make you more money in assets. Again, the amount of money a broker could make off of annuity, a lot of times it pales in comparison to what advisors make off you year in, year out. The money is locked away. Not necessarily. Most of these have withdrawal features up to 10%. Lower returns, again, sounds good on paper. It's a scare tactic, but I don't know. Would you rather be down 38% or zero? The lower returns can come in if the market's surging, and that's why we think this is a great diversification pool. And it's a bad investment. I mean, it's really hard to say anything on the surface is a bad investment. It needs to fit what you're trying to accomplish, and that's the key. So remember, who's benefiting from this information? Where's this information coming from? It's coming from financial advisors in Wall Street because they don't want you in a competing asset class. They want you to invest the way they tell you to invest because it maximizes their profit and not yours. 99% of economists agree. There's almost a consensus in the ivory tower that annuities make sense for the consumer. There have been 2,000 articles about annuities written by card-carrying professors since the 60s, and 99.9% of them are pro-annuity. So remember, these are folks that are just studying the math and the data. They're not making money off this. They're not trying to sell products. This should be pretty eye-opening, in my opinion, that people who don't have a horse in the race are saying, hey, these solutions make a lot of sense for reducing risk in retirement. Here's another example. So Monte Carlo simulations, that's what a lot of advisors use to run your retirement plans. And these two gentlemen, both economists, came out and said, we've crunched the numbers and annuities help improve retirement outcomes compared to investments alone, right? So this is what we talked about, a scientific solution, not just Wall Street propaganda. The numbers show that incorporating these types of investments, you're better off. Adding in an income annuity allows the retiree to get the same or higher income with lower risk of outliving savings than an investment-only approach. That just means, again, following really the Wall Street investment strategy. Allows the retiree to spend more than investment-only approach without significant risk run. So we talked about that before. When you have this guaranteed income, it allows you to be more confident and stick to your investment plan for what's not in an income producing investment. And it can enhance the value of heirs over the long term. So again, there's the ability that this is a really good wealth transfer tool as well. We don't spend as much time on that we can if you want to talk to us, but really this is to maximize your income and live the retirement that you want and deserve. Dr. David Babel, he was a fellow at the financial institutes at the Wharton School. And he said for a 65-year-old person in decent health to have enough retirement money to securely last throughout their remaining life, it most likely costs more without a lifetime income annuity than with them. That is why most economists agree annuities are a preferred retirement option. It's the risk of not having them is greater than the risk of having one. Olivia Mitchell and other economists, mutual funds do not protect against longevity risk, the risk of outliving your assets. If you buy an annuity, it makes sure that you don't run out of money when you are in your 80s or beyond, removing that longevity risk. We don't want you worried about living too long. We want you to enjoy your life, be happy and healthy, and these products help get you there. So what does this all mean? Well, what we see every day is your retirement plan, especially if you're working with a financial advisor, it creates little to no certainty, right? And it's because you're in Wall Street investments. So you're always at the mercy of the market. Okay? That asset projection, which is what it is, it's a projection, there's no guarantees, right? So that's why retirement and investing can be very stressful. You're always at the mercy of the market, and we don't want you to have to feel that. And in this solution, it's a perfect complement, as we just talked about, to improve retirement outcomes. You know, we're not saying all your money should go on something like this. Usually it's not an all or nothing with everything, right? We believe this is what really diversification means, right? Wall Street and financial advisors preach diversification, but you're diversified in what they sell and what maximizes their profit, right? We think this type of solution, it's a great complement because you're still going to have your typical investment strategy. This just does what we've just spent the last few minutes talking about, is guaranteeing income and giving you more confidence that you're going to not run out of money as you age. So here's the benefits of what we provide being a retirement advocate. We finally give you transparency on the fees you pay, which is completely missing from the market, right? Wall Street hides their fees all day long. It's really hard to find them, even for me who's been doing this for over 20 years. So you're going to have a hard time finding them. And then the other thing, there's the second piece to that is the value that you're getting. Fees in and of themselves aren't that bad if you're getting some value for it. Unfortunately, what we show you pretty easily, though, is a lot of quote unquote value you're getting from investment management isn't there. Hence, what you're paying is way too expensive. We want to create a retirement plan that matches your needs. So again, talking about this, you sit down with an advisor today, they tell you what your retirement plan should look like. We don't think that makes much sense. It's your life, it's your money. You tell us what you're trying to accomplish, and then we can connect you to the right pieces to make that plan a reality. Evaluate all your investment choices, not just Wall Street. This is huge, right? Wall Street financial advisors, they've really kind of created a monopoly because most of them do the same thing, invest the same way, charge the same way. So you're not getting good information about all retirement investment options, and we'll make sure you understand them. We'll show you how to create guarantees in retirement, which we think is so important. We're going to show you how to truly reduce stock and bond market risk. Again, asset allocation does not reduce risk the same way it used to. We can show you tools to significantly reduce that risk. And then strategies to maximize retirement income. And we say 2 to 10 times. So we have solutions that we work with, as we mentioned on this slide, the product we just were talking about today can increase retirement income by 250%. And then the 10 times is, we didn't spend a lot of time today, but we spent a lot of time helping people realize how you can leverage real estate rentals and create cash flow that can be 10 times what Wall Street is going to give you from following their advice. And by the way, just the real thing on the real estate advisors love when we talk about real estate is, oh, well, you don't want to be fixing toilets or chasing money down. Well, a lot of you don't manage your own money. Why would you manage your own properties, right? So our solution, when we look at ROI for any potential investment, if it's something of interest, it's fully baked in to have a property manager. So these are the types of things that we can at least help you explore. How can we maximize your income? How can we create guarantees? How can we put you in the best position to live the retirement that you want and deserve? So we encourage you to take back control of your retirement. Like I said, whether you realize it or not, Wall Street and financial advisors have kind of hijacked your retirement, right? They're guaranteed to make money off your investments. Believe it or not, you're not. We think that's wrong. That's where we come in at Wealth Minus Wall Street, is to be your advocate and make sure your money that you worked really hard for is doing all that it should be doing to make sure you have the best retirement for you and your family. So this is how you can contact me. Everybody who listened, I'd be happy to schedule a free conversation, 30-minute conversation. You can ask me any questions about topics we covered or what we do in general, and would be happy to answer any of those questions and again, point you in the right direction that will benefit you and your family. Thanks again for taking the time to listen, and you have a great day.